Okay, good morning, grad and business. Now we will still with me, Miss Mega. We will learn about accounting, but today we will learn about new topic. So the topic today is about interpretation of accounting ratio. So I will just directly share our PPT for today. Okay, please prepare yourself and we discuss this new topic. So basically, if we want to study this topic, we must excel for the previous topic because we are still talking about the same things. It's about accounting ratio. Remember, the last topic we are trying to calculate and try to define different kind of accounting ratio. And after we calculate all the accounting ratio with the formula, and we got the all of the ratio, and we find it from the present year and also for the past year. But for today, we will learn how to interpret, how to give recommendation and suggestion, and how to like make decision making from what we already have. So that's what we will do for today. Okay. The learning outcome for today is by the end of the chapter, you will be able to, the first one, prepare and comment on simple statement showing comparison of results for different years. So it's still the same company, but different years. The second one, make recommendation and suggestion for improving profitability and working capital. So, and then the next one, understand the significance of the difference between the gross margin and the profit margin as an indicators of a business efficiency. And then the next one, explain the relationship of gross profit for the year to the valuation of inventory, rate of inventory turnover, revenue, expense, and equity. So it's about four learning outcomes that we will learn today, but I think for today we will just discuss about three of them, and then we will continue for the next meeting. And for the first one, we must realize that why we are making the analysis ratio and compare it. So if you want to compare something, it should be the same things. So it will have to give a good results. If you want to compare something, it should be apple to apple, not like this picture. He tried to compare about apple to orange, which is will not give a good results, because if you want to compare something, it should be the same thing, like apple to apple or orange to orange, right? So in here we want to compare the results of different years. So this is still the same company but different years. Okay, absolute figures versus the use of ratio analysis for comparison between two financial years. This is 2018 and this one is 2019. In 2018, we can find there are like current asset, current liability, and working capital, right? 10,000, 5,000, and 5,000. 2019, 20,000, 15,000, and 15,000. From here, we can find current ratio is 2 compared to 1. And for 2019 is 1.333 compared to 1. It's totally different. So there are like use of ratio. Ratio of a business for the current year can be compared with those of previous years. So the year before today. Ratio of a business can be compared with those of another similar business in the same industry. So it should be the same industry and similar, because if this industry is different, that could be hard to compare, right? And ratio of a business for the current year can be compared with ratio derived from the budget and forecast to decide whether the target content in them were achieved. Just to find out, we do have like this kind of goals. We want to find out which are we already reached the goal or close to the goal. That's the meaning. And here are our work example. You can find this example from your book. I just take directly from your book just to make us easy. Okay, to learn this one, just open this page and I will explain the next one. So in here, this is the old data on 2018 and 2019. This is like tailspins industries provide the following information for the years ended 31st December 2019. So we do have like the sales, gross profit, profit for the years, complete capital employee, closing inventory, opening inventory, trade receivables, balance at bank, bank overdraft, trade payable, out of total sales, credit sales, and so on and so on. So let's jump to the next table. So this is like the ratio analysis for tailspin industry. We want to interpret and to give some comment to every ratio that we will do. But first, we must find out the ratio. Okay, the first one is gross margin. For the gross margin, the formula is gross profit divided by sales times 100. And from that, we can find that the gross margin for 2018 is 50%, and the gross margin for 2019 is 60%. Okay. For profit margin, the formula is net profit divided by sales times 100. Remember, net profit in here is about profit for the year. So, in 2018, we got 33.33%. Later, we will come to this one. And then total expenses, the formula is gross profit minus net profit. So this in here we got all of the expenses. It's about 35,000 minus 21, we got 14,000, and then 48 minus 26, 667 equal 21,333. And for the ROC, return on capital employee, the formula is profit before interest divided by capital employee times 100. Then we got 21,200 divided by 84. It's times 100 is 25.24%. And for the 2018, it's about 22%, sorry. And the current ratio is current asset divided by current liability. So it's 2.4 compared to 1, and the 2019 2.1 compared to 1. And for profit margin, we got in here the profit margin is 30%, and 2019 33%. So it's getting increased. Okay, keep in mind this whole of analysis. And then the next one is liquid debt ratio. The formula is current asset minus inventory divided by current liability. So we got 2019 1.4 compared to 1, and 2019 0.63 compared to 1. And the trade receivable turnover ratio, remember, trade receivable turnover ratio is all about the customer, how many times the customer to take to pay all of her or his debt. So this is like in here we make the formula into days, so we times 365. So trade receivable divided by credit sales times 365. So it's for 2018 is 30 days. It takes 30 days to pay all of the day. 2019 it's about 34 days. And then we do have trade payable turnover ratio. The formula is trade payables divided by credit purchase times 365. And how much we got 2018? 61 days. 2019, 69 days. Getting longer. And for inventory turnover, remember inventory turnover, it's like how many time for our inventory to take turn, come and out like that. So the formula is cost of sales divided by average inventory. It says 2018 we got 7.4 times, but for 2019 it's about 4 times. Getting increased. So this is comparison of current asset and cost of sales for 2018 and 2019. In here we calculate all of the current asset. It's about 12 in 12,000 2018. For 2019 is about 16,000, getting increased. And cost of sales 2018 is about 49,500. 2019 is about 14,000. Okay, after we calculate all of the ratio, I just like I don't put the formula and how you calculate, just the results. So from this kind of results, we can give some comment. Okay. So the first one in here, we do have like gross profit, and the comment that we can make is the gross profit margin has improved from 50% to 60%, indicating an increases of $10 gross profit for every $100 of sales. So it's about $10. And then the next one, the profit margin has also improved. For every $100 of sales, the net profit has increased by $3.33. So it's still improved. And for the total expense, well, in here, even though the gross margin and the gross profit is increase, but in 2019 it's become the increase also. So in here we can find comment, the total expense have increased by 7.333. This is because although the profit margin increased, it did not increase in proportion to increase in sales 2019. So this is indicate inefficiency in managing expenses for 2019 because too many expenses for that. Okay, the next one is ROC, or return on capital employee. In here, if you see in the glance of data, well, it's decreased. So what that mean by decrease? So the return on capital has decreased on us. Or 2019 getting a return of $5 less for every $100 they invested in the business. So that's for the comment that we can make. For the current ratio, the current ratio has remained almost the same with the small decrease. You can see it's just between 2.4 to 2. So it's only the descent is only 0.4. However, an ideal current ratio is between 1.5 and 2. So the current ratio has improved actually. And liquid ratio, in here we can find it's about 1.5, 1.4, and 0.63. The comment that we can make from here is the liquid ratio has decreased to 0.63 compared to 1, which as an indication of liquidity crisis. The ideal liquid ratio is 1 compared to 1. So it's not good. Okay, for the trade receivable turnover ratio, the trade receivable ratio is quite pleasing overall. So why? Though it was worse a little from 30 days to 34 days, debtors are now paying their debts on an average of 4 days later. So not a big gap, so it's still good. But if we see from the trade payable turnover ratio, it means how we can pay all of our debt to our suppliers. So how is the comment? This ratio has changed for the worse. Why? The business is now taking more than a week longer to pay its trade payables than it was in 2018. See, it's the difference about 8 days. Yeah, more than a week. So it's not good. Inventory turnover. So the ratio has also changed for the worse drastically. The business is not selling and replacing its inventory as regularly as it did in 2018. So here are the comments that we can make from each ratio that already shown in our table in between 2018 and 2019. So after that, after we already find the comment, then we can jump to the recommendation and suggestion. So recommendation and suggestion for improving profitability. But remember, profitability ratio is divided into 3. The first one is the gross margin, profit margin, and return on capital employee, or ROC. So that's this 3. So we want to find recommendation and suggestion from these 3 items. The first one is gross margin. When the gross margin has decreased, it could be for a number of reasons, including higher suppliers costs because we buy our inventory that can be higher, and lower selling price due to trade discount and promotion over to customers because we provide them some discount and promotion. Increasing additional costs such as packaging or carriage can increase cost of sales. And then not passing on increasing costs to customer. Increase competition that can be force the business to compete by reducing the selling price to make it more competitive, just to make so our product can be compete to another product. So we want to make it more cheaper, just can win the customer's heart. Here's some that make it decrease, but there is some way. This is the recommendation to improve the gross margin. The first one is reduce cost. They could be like the transport costs, even the inventory itself. So we want to make sure that we can improve our gross margin, so we kindly like reduce some costs. So the next one is increase the selling price. So we are want to make our profit become increase, so we increase the selling price. And then to keep track on inventory, just to make sure our inventory is in a good quality. Just make sure the rate turnover of our inventory is in a good rate. So it's very important, right? And then the next one is reduce others cost. It could be like expense, it could be like rent expense, and so on and so on. For the profit margin, we must like minimize the waste. It's more similar to the expense. And then the second one is decrease the overhead. Overhead, that could be like something other beside the raw material. So it could be like our rent expense. We want to decrease, change to another place, and maybe we can go to the low, minimize. I mean like decrease our employee, something like that. So I think for the from the people that work to our company is the bad things, but for the business, I think this is one of the way, one of the reason why the company reduce their employee, just to make profit margin getting increased. Okay, so that's what we can learn for today. And oh, one more slide. Return on capital employed. So as profit plays an important part in this ratio, all the measures recommended to increase gross profit for you are applicable here. It means the suggestion and recommendation that we apply for the gross margin and the gross profit, it could be can applicable. It could be the same treatment also can make for the return on capital employed. So it means it's still the same. So I think that's all for today. So just to interpret the analysis ratio, first one we must find out all of the analysis ratio and then compare the number of between the present year and the previous year and give some comment from it. So increase it doesn't mean a good things and decrease it doesn't mean a bad thing. So we must know which kind of analysis that we are calculate today, and then find out what's the meaning of the analysis ratio and give some comment of it. After we already give all the comment and we do have the conclusion of it, so we can make some recommendation or suggestion. So this is very good for decision making for the owners and for others also. So I think that's all for today. Please review this material. If you do have question, you can ask directly to our Google Classroom, and please do your assignment on time. But the most important is just stay at home, be healthy, and always have fun. Okay, that's all for today. Thank you.